Imagine firing your financial advisor, opening your laptop, and typing a single sentence into a chatbot. You tell it you have $50,000 in savings. You are 35 years old, and you want to retire by 50. In less than 4 seconds, the AI spits out a beautifully formatted, highly confident, step-by-step financial plan. It suggests specific asset allocations, names a few exchange-traded funds, and even projects your compound interest. It feels like you just got $1,000 worth of premium wealth management advice for free. But there is just one massive, terrifying problem. The ETF the AI just recommended you put your life savings into does not exist. The AI hallucinated the ticker symbol, the expense ratio, and the historical returns. If you had blindly followed its advice, you would have handed your money over to a phantom. Welcome to the new frontier of personal finance.
According to recent data, over 55% of retail investors and everyday earners are now using generative AI tools like ChatGPT and Claude to make financial decisions. From budgeting and debt payoff strategies to tax optimization and stock picking, the masses have quietly outsourced their financial brains to large language models. AI stocks and AI financial tools ranked among the most searched terms of the year, and the adoption rate is only accelerating. But behind the convenience and the futuristic appeal lies a hidden trap that nobody is talking about. These models are not truth engines. They are predictive text generators designed to sound plausible, not to be accurate. When they fail in the realm of personal finance, they do not just give you a bad recipe for dinner. They trigger IRS audits, destroy retirement timelines, and expose your most sensitive financial data to the open web.
If you have ever asked an AI for money advice, or if you are thinking about doing it to save on advisor fees, this video is going to show you exactly what is happening behind the screen. My name is Guru, and I have spent decades studying the intersection of human psychology, systemic financial traps, and wealth preservation. Today, we are going to run a live experiment. I am going to pit a top-tier AI model against a certified fiduciary financial planner across 3 high-stakes financial scenarios. The results are not just surprising, they are a massive wake-up call for anyone trying to build wealth in the modern economy. And stick around, because later in this video, I am going to reveal the exact cyborg prompting framework that the top 1% of investors use to safely harness AI without falling victim to its catastrophic hallucinations.
Let us start by understanding why this shift is happening so fast and why it is so incredibly dangerous. For the average American, financial advice has historically been gated behind high fees, minimum account balances, and intimidating jargon. If you have less than $250,000 in investable assets, most traditional wealth managers will not even take your call. You are left to scour internet forums, watch YouTube videos, and piece together a financial plan on your own. Enter generative AI. Suddenly, you have a patient, infinitely available, highly articulate financial sounding board sitting in your pocket. It does not judge you for your credit card debt. It does not charge you a 1% assets under management fee. It just gives you immediate, structured, and incredibly confident answers. But here is the first curiosity loop we need to open. Why does AI sound so smart when it is actually just guessing? Large language models do not have a database of financial facts. They do not know what the SEC requires, and they cannot do real-time complex math unless specifically hooked into a calculator plugin. Instead, they predict the next most likely word in a sequence based on billions of pages of internet text. When you ask an AI for a retirement strategy, it is not calculating your sequence of returns risk. It is simply regurgitating the most common phrases associated with retirement planning found on Reddit, Investopedia, and financial blogs. It is a stochastic parrot. It mimics the language of a financial expert perfectly, but it lacks the underlying reasoning engine. This creates what behavioral psychologists call the illusion of competence.
Because the AI uses perfect grammar, structures its answers with bullet points, and uses authoritative financial terminology, your brain automatically assigns it a trust score that it has not earned. In the medical field, they call this automation bias. In the financial sector, it is a ticking time bomb. In late 2023 and early 2024, regulatory bodies like FINRA and the SEC began issuing urgent warnings about AI hallucinations in finance. They found instances where AI chatbots invented fake regulatory rulings, cited non-existent court cases regarding tax loopholes, and provided mathematically impossible compound interest projections. Let us look at the first major trap: the hallucination hazard and the math deficit. I want to walk you through a real-world scenario that a colleague of mine tested. He asked a popular AI model to calculate the monthly payment on a $300,000 mortgage.
He asked it for a 6.5% interest rate over 30 years, and then asked it to build an amortization schedule. The AI confidently generated a beautiful table. The problem was that the math was completely wrong. The AI failed to carry the decimal correctly in its internal processing, resulting in a monthly payment that was off by nearly $400. Over the life of the loan, that hallucination would cost a homeowner over $140,000 in miscalculated equity. AI models are notoriously bad at multi-step arithmetic. They are language models, not calculators. Yet millions of users are asking them to project their net worth over 20 years using assumed inflation rates, variable tax brackets, and market volatility. The AI will confidently give you a spreadsheet that looks like gospel, but the numbers are essentially financial fiction.
Now, let us move to the second and perhaps most terrifying risk: the privacy nightmare. To get good financial advice, you have to provide intimate details. You have to share your income, your debt, your social security number, your employer, your children's ages, and your medical expenses. Think about what happens when you type your exact W-2 income, your mortgage balance, and your credit card debt into a public AI prompt. You are feeding your most sensitive, identifiable financial data into a machine learning model that uses user inputs to train its future iterations. While many companies claim to have opt-out features for data training, the reality of data retention policies, server breaches, and third-party API sharing means your financial blueprint is no longer entirely yours. Imagine a world where targeted phishing scams are highly personalized messages referencing your exact debt-to-income ratio. That is not science fiction. That is the current trajectory of data scraping. But I know what you were thinking. You were thinking that you were not asking it for complex tax evasion strategies or 30-year amortization tables. You just use it for basic budgeting and debt payoff. So you wonder if that is really that dangerous. To answer that, we need to run our experiment. I have prepared 3 distinct financial scenarios. I fed these exact scenarios into a leading AI model, and then I handed them to a certified financial planner with over 20 years of fiduciary experience. The differences in their approaches will completely change how you view machine-generated advice. Let us look at scenario number 1, the debt trap. The prompt was from a 32-year-old making $75,000 a year. They had $15,000 in credit card debt at 22% APR and a $20,000 auto loan at 5%. They also had $3,000 in savings and wanted to know how to pay this off. The AI immediately suggested the debt avalanche method. It told the user to pay minimums on the car loan and throw every spare dollar at the credit card because of the higher interest rate. It then suggested picking up a side hustle, cutting dining out, and using a 0% balance transfer card. On the surface, this is textbook, mathematically sound personal finance advice that you would read in any basic finance blog. But the human fiduciary advisor looked at the exact same numbers and immediately spotted the behavioral and systemic risks the AI missed. The advisor noted that a $3,000 emergency fund is less than 1 month of living expenses.
If the user throws all their cash at the credit card,
and their car breaks down, they will be forced to put the repair on the high-interest card, restarting the cycle of debt. The advisor's first step was not the debt avalanche. It was pausing all aggressive debt payoff to build a $5,000 cash buffer in a high-yield savings account. Furthermore, the advisor pointed out that a 0% balance transfer requires a good to excellent credit score. The user likely does not have this if they are carrying maxed-out cards at 22% APR. The AI gave a mathematically perfect answer for a robot. The human gave a survivable answer for a human being. Now let us examine scenario number 2, the retirement catch-up. The prompt came from a 50-year-old with $120,000 in their 401k, wanting to retire at 65 with $1 million. They asked what their asset allocation should be and what specific funds they should buy. The AI calculated that the user needed an aggressive 8 to 9% annualized return to hit the goal. It suggested an 80-20 split of stocks to bonds and actually named 3 specific real-world index funds. But then it hallucinated a 4th high-growth emerging market tech ETF with a ticker symbol that did not exist. It also completely ignored tax diversification, assuming all withdrawals would be taxed at the user's current bracket. The human advisor immediately flagged the psychological danger of the AI's advice. Chasing an 8% guaranteed return at age 50 requires taking on massive equity risk. If the market crashes when the user is 62, their retirement is destroyed due to sequence of returns risk. The advisor shifted the focus from chasing $1 million to optimizing cash flow. They suggested maximizing catch-up contributions, which the AI failed to mention, and shifting the strategy toward building a bond tent to protect against early retirement market shocks. The AI tried to win a math game. The advisor protected the client's future livelihood. This brings us to scenario number 3, the tax write-off illusion. The prompt was from a freelance graphic designer making $90,000, asking for the most aggressive legal tax deductions to lower taxable income. This is where the AI becomes genuinely dangerous. The AI listed standard deductions like home office, software, and internet. But then, trying to be aggressive as prompted, it suggested deducting a percentage of the user's family vacation as a business networking trip. It also suggested writing off a personal vehicle used for commuting, and even cited a vague, non-existent IRS publication to back up its claim. The human advisor stopped the client immediately. Commuting is never deductible, and mixing personal vacations with business without meticulous, audit-proof documentation is the fastest way to trigger an IRS penalty. The advisor instead focused on the boring, highly effective strategies the AI glossed over. These included setting up a solo 401k to shelter up to $23,000 of pre-tax income, and utilizing Section 179 depreciation for actual business equipment. The AI gave advice that could lead to tax fraud. The advisor gave advice that legally shields wealth. This brings us to the concept of the fiduciary gap. When you hire a certified financial planner who operates as a fiduciary, they are legally bound by law to act in your best financial interest. If they give you negligent advice that destroys your portfolio, they can be sued, lose their license, and face regulatory action. But when you ask an AI for advice, who is liable? The tech company has buried a disclaimer in their terms of service stating the model is for informational purposes only and can make mistakes. You are taking on 100% of the legal and financial risk for advice generated by a machine that faces 0 consequences for being wrong. Now, I promised you a solution. I am not here to tell you to delete your AI accounts and go back to doing everything manually. AI is the most powerful tool for financial synthesis we have ever seen, but only if you stop treating it like an oracle. You must start treating it like a highly capable but deeply flawed intern. I call this the cyborg investor strategy. You must combine the processing speed of AI with the critical reasoning of a human. Here is the exact framework you need to use. Rule number 1 is to never ask AI for decisions. Ask it for frameworks. Do not ask what stocks you should buy. Instead, ask what the historical differences in volatility and tax efficiency are between a total stock market index fund and a dividend growth ETF. Use AI to explain concepts, summarize earnings calls, and compare historical data sets. Let the AI do the heavy lifting of research, but you must be the one to pull the trigger on the decision. Rule number 2 is the verification mandate. Anytime an AI provides a specific number, a tax code, a ticker symbol, or a legal ruling, you must independently verify it on a primary source website like the IRS, the SEC, or your brokerage. If the AI tells you about a specific tax loophole, search the IRS website directly for that exact code. You will be shocked at how often the AI has slightly altered the income limits. Rule number 3 is data sanitization. Never input your real numbers into a public AI model. If you want the AI to help you build a debt payoff calculator or a retirement projection, use variables. Tell the AI to assume person A makes X dollars, has Y debt at Z interest rate. Let the AI build the mathematical formula and the Python code, and then plug your real private numbers into your own local spreadsheet. You get the benefit of the AI's coding and structural logic without sacrificing your data privacy. Rule number 4 is the devil's advocate prompt. This is the secret weapon of the top 1%. Once you have a financial plan, feed it back into the AI and use a specific prompt. Ask it to act as a highly critical, bearish financial auditor. Tell it to review your financial plan and list the top 5 catastrophic points of failure and hidden tax implications. Force the AI to tear its own advice apart. You will uncover blind spots that you never would have seen on your own. This simple step transforms the AI from a dangerous oracle into a powerful stress testing engine. Let us take a step back and look at the macroeconomic reality of what is happening right now. The financial services industry is facing a massive disruption, and the traditional gatekeepers are terrified. For decades, Wall Street and major brokerages have charged retail investors exorbitant fees for basic portfolio construction. Now, a free chatbot can generate a reasonably accurate modern portfolio theory allocation in seconds. To combat this, these institutions are rushing to integrate AI into their own platforms, creating walled gardens of financial advice. But this creates a new, hidden conflict of interest. When a brokerage's proprietary AI recommends an investment, is it recommending the absolute best fund for your retirement? Or is it recommending the fund with the highest internal revenue sharing agreement? The opacity of AI algorithms makes this nearly impossible for the average consumer to audit. This is why your own financial literacy is your only true defense. You cannot outsource your critical thinking to a black box algorithm owned by a publicly traded tech company whose primary fiduciary duty is to its shareholders, not to your retirement. We are also seeing the rise of AI-driven market manipulation. Bad actors are now using large language models to generate thousands of highly convincing SEO-optimized financial articles and fake earnings reports. These fabricated narratives are designed to trigger algorithmic trading bots and move microcap stock prices in a matter of milliseconds. If you were using AI to scrape financial news and summarize market sentiment, you might be inadvertently feeding your portfolio directly into a coordinated pump and dump scheme. The SEC has already begun prosecuting cases where AI-generated press releases caused massive temporary spikes in stock valuations. The speed at which misinformation can now be synthesized and distributed is unprecedented in financial history. This brings us to the psychological toll of the AI economy. When you have an infinitely patient machine in your pocket that can validate any financial bias you hold, confirmation bias goes into overdrive. If you believe that a certain obscure cryptocurrency is the future of money, you can prompt the AI to write a 10-page thesis defending that exact position. It will happily cherry-pick data and construct a flawless logical argument for a terrible investment. We are losing the friction that traditional research requires. The struggle of reading a dense 10K filing or parsing through a boring Federal Reserve minutes report is what builds actual financial conviction. When you remove the struggle, you remove the deep understanding required to hold an asset during a 30% market correction. AI gives you the answer, but it does not give you the conviction to stick with it when the market panics. So how do we adapt to this new reality without becoming Luddites? The key is to redefine the boundary between information and wisdom. AI is exceptional at information retrieval, data formatting, and basic coding. It can build you a Python script to backtest a moving average crossover strategy in minutes. But it lacks the wisdom to understand the macroeconomic regime change that might render that historical backtest completely useless in the current interest rate environment. Wisdom requires context, human intuition, and an understanding of systemic risk. The most successful investors of the next decade will be those who use AI to automate the tedious parts of their research. They will free up their cognitive bandwidth for high-level strategic thinking. They will use AI to gather the dots, but they will connect the dots themselves. Let us revisit the concept of the cyborg investor one more time, because it is the most important mental model you can adopt today. A cyborg is not a human replaced by a machine. It is a human enhanced by a machine. In the financial context, this means using AI as your junior analyst. You are the portfolio manager, and the AI is the 22-year-old quant who just graduated and is eager to please, but lacks real-world market experience. You would never let the junior analyst make the final trade decision without your review. You would expect them to make math errors, miss nuanced regulatory changes, and occasionally present you with completely fabricated data. By adopting this mindset, you completely neutralize the danger of AI hallucinations. You stop expecting perfection and start expecting a rough draft that requires your expert editing. This shift in perspective also protects you from the emotional devastation of a bad trade. When you blindly follow a guru or an algorithm and lose money, you feel betrayed and helpless. But when you use AI as a tool to inform your own thoroughly vetted decision, you retain full ownership of the outcome. You remain the master of your financial destiny. As we look toward the future, the integration of AI into personal finance will only deepen. We will soon see autonomous AI agents that can execute trades, rebalance portfolios, and harvest tax losses without any human intervention. While this sounds like the ultimate dream of passive income, it introduces catastrophic tail risks. A poorly coded autonomous agent caught in a flash crash could liquidate your entire net worth before you even wake up. The regulatory framework for autonomous financial agents is virtually non-existent at this point. Until robust guardrails and insurance mechanisms are established, keeping a human in the loop is not just a preference, it is a strict requirement for capital preservation. Ultimately, the rise of AI in finance is a mirror reflecting our own financial discipline. If you are disciplined, curious, and rigorous, AI will act as a multiplier for your wealth-building efforts. If you are lazy, seeking shortcuts, and looking for a magic button to get rich quick, AI will simply accelerate your financial ruin. The tool does not change the fundamental laws of compound interest, risk management, or market psychology. It merely changes the speed at which you execute your strategy. And in the hands of the unprepared, speed is just a faster way to hit a wall. The institutions know this, which is why they are spending billions to build proprietary AI models. They are building moats of intelligence that the retail investor cannot easily access. Your counter strategy must be agility and extreme skepticism. You must be willing to question the consensus narrative that the AI models are trained to regurgitate. You must be willing to look at the raw data, verify the sources, and trust your own hard-earned intuition over the smooth, confident prose of a language model. The matrix of modern finance is being rewritten in code, but the rules of human nature remain exactly the same. The financial industry is undergoing a seismic shift, and the automation of your financial brain is only one piece of the puzzle. AI is not going to replace the need for financial literacy. It is going to ruthlessly punish those who lack it.
The people who will thrive are the ones who possess the critical thinking required to spot a hallucination before it costs them their retirement.
You cannot automate your way to financial freedom, and you certainly cannot outsource your financial judgment to a machine that does not have a pulse. If this video changed how you think about the intersection of technology and your money, you need to watch this video right here. In it, I break down the exact mathematical blueprint for building a bulletproof emergency fund in a high-yield environment. Because if the AI economy teaches us anything, it is that your personal safety net is the one thing you can never afford to outsource. Click right here, and I will see you in the next one.